Thanks for taking time away from your very busy, it sounds like eventful week and more. You've got a busy but kind of fun sounding week, it sounds like, out there in sunny Las Vegas.
It's Christmas party week. It's our little company Christmas party. We really enjoy ourselves. We go to and have a nice dinner, nice little party, and just have a lot of fun. And it's really enjoyable. It's also one of the staff's birthday today, so
Nice.
it's kind of like an extra time. It's like an extra party today.
Two parties in one. That's
And
great.
we're taking a 3-day weekend because we're closed tomorrow for the Christmas party. So it's like a 3-day weekend, just birthday. We're getting a lot done.
Yeah, it sounds like it. Sounds like you're very busy there. So we said on the last show we're going to preview. We're going to go over the 2026 preview from who I consider to be the prognosticator of prognosticators, the one and only Matt Dahl. You're going to tell us what. Okay, for compliance purposes, I can't say you're going to tell us what's going to happen in 2026. You're going to tell us what you think is going to happen in 2026.
I am.
All right. Whether or not that ends up being correct, well, that we'll have to wait and see. But we're at least going to hear what Matt thinks is going to happen. So you're still tracking to look pretty good for 2025 so far, right around 68.89 as we speak right this second, December 11th, 104 Eastern time. I think your original range was 6,900, 67 to 69, something like that. So you're tracking very well for this year so far.
Yeah, I mean, I think initially we were 6,800 to 7,000, which is kind of the range I thought it would. And honestly, I think it's going to surpass that. I think we'll be a lot closer to 7,100, maybe the other side of 7,100 by the end of this year, just because of the momentum that's starting to take place. There's a lot of sort of headwinds and risks, uncertainties in the rearview mirror. The government shutdown is over. The data is coming in. The FOMC meeting is complete. And frankly, the FOMC meeting, and we talked about this last show, right? That we know it's going to be a hawkish cut. So, which effectively, and that's what the consensus was. It was just going to be very hawkish. So anything that's not overly hawkish, no surprises, is going to be viewed as a dovish event. Okay, so that's what we took from it. Yes, I found it to be not a hawkish cut at all. I found it to be a very dovish cut and an acknowledgement of what he said specifically. And they were talking about it quite a bit the last couple of days, specific to the labor market. Okay, because the labor market has been showing about 40,000 new jobs a month. Okay, 60,000 jobs a month. That's about the number that needs to be created. But these are surveys. Okay, these are surveys for that month. The actual real number comes the following month when the data actually shows up. It's not just the survey data; it's what they call the revised data. That's the correct data. Okay, and the revised data has been revised negative by quite a bit. And what Jay Powell said yesterday, I found very interesting, and kind of gave us a window into next year, that he believes we're not making 50, 60,000 jobs a month right now. We're actually losing 20,000 jobs a month. Okay. So, and the other thing he said something yesterday that he's never said. Okay. And if I didn't know any better, I would think he listens to the Intelligent Investment Show.
It's about time. We've been saying for
right?
a long time he needed to listen.
He said,
you've had a lot of tips for him over the years.
I did. Just you know what? I can help him out quite a bit. But you know what, though? I think he would appreciate it because Jay Powell is known to have a very good sense of humor. He's one of those like erudite, dry British wit kind of guys, which I really appreciate. Which I
like those guys. Those are some of the best.
So, but he talked about the inflation data being is all attributable to tariffs, albeit very, very minor inflation. It is attributable to tariffs, and tariffs are nothing more than a single price level shift. It's not true inflation. It's a price level shift based on a tariff. It's not a supply demand imbalance. Okay. And that will all be, as far as the year over year numbers, that's all going to be pretty much culminated by Q1 of next year. So if we don't see any outsized inflation coming from a pickup in demand or a contraction in supply, which I don't see that taking place. Okay. In fact, supply chain should be ramping up. Productivity should be ramping up. Deregulation should be deregulating, which should cause more productivity and better supply chains. So we don't see inflation as outsized risk in 2026 at all in any way. Okay. So, and I think that's sort of the narrative that's starting to permeate through the Federal Reserve. There was 3 dissents on the cut yesterday. 2 were for no cut. 1 was for a cut of 50 basis points. Okay, from Amirin. So, I think as we look at the dot plot, I don't really care about the dot plot because the dot plot just changes every time by a pretty material amount every single SEP meeting, which is every other Fed meeting. So I tend to not really pay a lot of attention to it. When I was watching the press conference and the aftermath, I hate to say it, but I actually agreed with Jeffrey Gundlach for once. Okay, he's kind of a bear. You know what I mean? He's kind of just he's your typical. He's a really good bond guy, but he's kind of always has kind of a bearish tilt to him. Not that he's wrong.
Isn't that pretty typical of bond guys? I mean, to be honest, let's call it what it is. Bond guys benefit from bearish scenarios, right? I mean, for the most part, bonds are going to be in a lot more demand when things are not so good. So you just seem to see a lot more pessimism from the bond guys. Again, it goes back. I'm pulling this one back from a long time back. It's the college roommates again. You got the fun equity guys, and you got the nerdy bond guys over there on the other side, right? The bond guys are right a lot of times, but they're not as much fun.
No, they're not as much fun. No, he might be a hoot. Who knows? But frankly, if you want your bond prices to go up, rates have to come down. For rates to come down, there has to be some sort of maybe a cooling of the economy or less inflation or something like that. So that's kind of maybe baked into just their general narrative. It's hard to say. I'm not a fixed income master like Jeffrey Gundlach is, but he said something that was very, very smart, and is obviously this would never happen, but it would be the perfect thing. They asked him, who does he think should be in charge of the Federal Reserve? Who should be the new chairman of the Federal Reserve? And he said, the 2-year Treasury note should be in charge of the Federal Reserve, because now finally the 2-year Treasury note always runs ahead and is telling the Federal Reserve where they need to be. So the 2-year Treasury today is 356. They lowered rates yesterday to between 350 and 375. So the Fed is finally now, after all this time, back to where the 2 years. And again, back in 2021, when the 2 years shot to the moon, and the Federal Reserve said, no, inflation is transitory, inflation is transitory, inflation is transitory. Meanwhile, the bond market is selling the 2-year Treasury note off like it has, 7 different kinds of contagious diseases, and it's going up over 5%. The Fed's not doing anything. Finally, they retire the word transitory and they start raising rates. And then it, of course, it goes through where the 2-year is, and the 2-year starts to come back. The 2-year started to price in disinflation in late 2022, early 2023. Okay, that's when it started to head that way. And of course, what do we hear all through 2023 and 2024? Inflation. When the 2-year was like, hey guys, we're not seeing that. We're buying at these yields. We're not selling at these yields. So obviously, you can't put a financial instrument as chair of a government institution. But honestly, if there was some way for the Federal Reserve to have to pay attention to, or have to be within some area of the 2-year Treasury Reserve without some sort of outsized economic development, like when they met on an emergency meeting for COVID or something, I don't know that would be a bad idea. If they had, no matter what happens, they have to be within 100 basis points of that 2-year.
What would that look like, though? Would that be a federal mandate? I mean,
yeah,
a lot of things that I used to think were impossible have come to pass over the last 10, 15 years. So a lot of things that I did not think were things that I was taught in college that this is the way things are and they can never change. They've changed and they've been backwards that. But I mean, that would be pretty unprecedented, I believe, right? For there to be an actual mandate that the Fed had to do that, or.
Well, here's the thing. Who is the 2-year Treasury note? That's thousands and thousands and thousands of bond managers,
right?
Telling you what's happening with the domestic and global economy, versus the Federal Reserve Board, which is 12 people, smart people for sure, but they're not as smart as the bond market. Okay, and frankly, these bond managers, they get in there every day and they do it, right? And they're held accountable for their actions, okay, by clients, by their institutions that they work for, everyone. Whereas the Federal Reserve folks, they get to be academics and chin scratchers and talk in verbose language. And if they're right, they're right. If they're not, well, the data didn't really pan out that way. So the fundamental difference is the bond market has to look ahead. The Federal Reserve does a great job of driving with the rearview mirror, like we talked about last week.
Yeah.
Okay. So, if they had some tool that they had to use, like the 2-year or a 1 year or something like that, where the bond market had some true say into what that policy rate is, I don't know, that would be a bad idea. I'm not a overly accomplished bond manager to be able to make that determination. Jeff Gundlach, he is, right, and I think it was a great suggestion. I just wish there was a way to facilitate it.
How long has it been disconnected? You said it's finally back to in line with the 2-year for the first time in a long time. But how long has it been disconnected? When did it disconnect to start with?
Honestly, for the better part of 4.5, 5 years. Okay?
Yeah.
There was a time when the 2-year was coming down and the Fed and the policy rate was going up, where they intersected each other for about 6 months.
Yeah.
But other than that, no. In the bond market looks ahead. The Federal Reserve looks in the past. Okay.
Yeah.
If you're trying to make sure the economy is going to work 6, 9, 12, 18 months from now, you need to look at those folks who spend a lot of their time looking forward, not always looking at what already happened. I mean, it's great to see what the data says, and we've talked about this where the Federal Reserve looks at 3-month increments as signal if they're directionally the same. Well, that's fine, but they just predicted, they're taking what happened as what's going to happen, rather than what are the people that are very experienced in what could happen as far as yields and economics and macroeconomics. What are they thinking and what are they saying? I don't know that they don't take any of what happened in the bond market into account, or they do. I'm sure they do to some extent, but I think they need to pay a lot more attention to it. So hats off to Jeff Gundlach. I thought that was a great idea.
So what does all this mean looking ahead into next year for the equity markets? We've this may be a new Intelligent Investment Show record for the length of time that we've spent talking about bonds. We sprinkle bonds in. I know, boring. Yeah. So what does this mean for stocks? Let's get back to the fun college roommate. What does this mean for stocks in 2026?
He just broke down the door with a beer taped to his hands, like, stop talking about bonds, nerds. Dorks.
Yeah, let's talk about the fun side now a little bit. So what's going on over there?
Well, we're looking at 2026, right? That's what did we say last week? 2026 is over. 2026 is over. Okay. Yeah. So if you're looking into 2026 earnings to find out what 2026 is going to do, well, good luck. Okay. Yeah. We're looking into 2027 because as 2026 makes its trip around the sun, it's going to be pricing in early 2027 earnings to mid 2027 earnings to late 2027 earnings. And we're trying to land there. Okay. So, with $352 a share at 21, 22 times earnings, our range next year is 77.50 to 78.50. Okay. Now, we actually had this about a month and a half ago before everyone else came out with their numbers. Okay. But we didn't want to release it then. It's buddy though. It has a friend. Okay. And you ever seen that movie with Steve Martin and Jack Black and Owen Wilson called The Big Year, where they all go bird watching?
I have not. I think I've seen clips from it, but I've never actually seen the movie.
Okay. I mean, it's a bird watching movie.
Yeah.
No, so how can it not be amazing?
Yeah, of course.
It is. Great. It's so good. It's so good. There's a scene where they're watching a bald eagle get into its mating ritual. And these two bald eagles, they fly up and I guess how it works is they clasp their claws together, and then they free fall together and they spin as they free fall, and then they fall to earth, and I guess I don't know how it works. But that's how I see the equity markets and the 10-year working next year. I think the bond market is going to run the show next year because the last year and a half or so, the earnings revisions have, especially the last 6 months, the earnings revisions have been very strong. obviously ruled by AI and increased productivity and increased margins. I think the bond market is going to kind of reassert itself next year. Okay. And they're going to be very closely tied to each other. So we're looking at a range of 325 to 350 on the 10-year by end of year, right about 335, 340. If we had to be more granular, that's probably a good place for it to kind of land. And those two things lend to decent growth in the economy. Okay. And, without having too high of a cost of capital. So if you look at the highest multiples of the S&P 500 for the last 50 years, okay, the highest multiples always are when the 10-year is between 3 and 5%. Okay. Obviously you want it to the lower end if you can. Okay. But if it gets too low, now we start to worry about, well, is there enough growth to justify this multiple? If we have a 10-year sitting at 1.5%, why? So I think we're going to have a lower 10-year. I think we're going to have decent productivity. And I think the 10-year and our GDP are all going to be within about, 75 basis points of each other next year, which I think will be pretty strong, which is kind of where it needs to live anyway.
Yeah, it's so those two numbers are married together. So now let's talk through what does that free fall look like if the 10-year drifts out of that? You pegged it to 335, 340 to be very specific. Which is a bigger risk to the equity markets, that it falls below that or goes above it? Or is that cause and effect? Okay, so you're not worried about it shooting to 6, and what does that mean? You're looking at if it falls below that, it could be
right. If it shoots up to 6, that is obviously a demand issue, which is economically good, and then obviously Fed policy can bring rates up a little bit to cool it down. And don't get me wrong, I don't think we will finish at 77.50, 78.50 end of next year if we're looking at 4.5% inflation. It's not going to happen with a 4.5% policy rate. We're not going to get there. Okay.
Right.
It's going to be that would kind of be a gnarly year too. But if we have serious economic contraction, serious labor market problems, and we see that 2-year or that 10-year shoot right through, and we see the 2-year go down to mid to low 2s, high 1s, and we see the 10-year get into the 2.25%, 2.5% range because we have severe economic slowdown, you're going to watch that multiple on the S&P. It's at 23 right now. I mean, it'll probably finish next year at 21.5 to 22.5. That's my guess. You're going to watch the thing go right to 18, maybe 17. Okay.
Wow.
If we get that kind of a contraction. So that's what I worry about as far as if we get too low of a 10-year. That's the bond market kind of signaling that, hey, we've got some issues here.
And would you expect those two to move in concert with one another, or would one lead the other? In other words, is there a possibility in your mind that you see the 10-year dip below 3, say to 250, but the equity market still stay in that higher range for a little bit, long enough to be able to get out, basically, is I guess what I'm asking? Or do you think that as the 10-year breaks below 3, or the 2-year, as the 2-year breaks below that 3 mark, that you would already see the equity market falling with it?
No, I think next year is going to be leapfrog. Right now, the equity market's leading. Right now, the equity market is pricing in lower rates.
Okay.
It's getting there. So yeah. as the bond market starts to, I guess fulfill its promise to the equity, we call it, then the equity markets are now fully priced into that to that given yield and probably what it thinks is a forward yield, because we're sitting at 410 on the 10-year right now. It's been as low as 397 just a few weeks ago. So getting down to 340, 350, in that range, we're not talking about a massive change here. We're talking about 50, 60 basis points. Okay, we're not talking about 200 basis points. So once I think right now it's probably pricing in a 3.75, 365 10-year. So what's going to happen then is I think the bond market is going to put itself back in charge by the end of the first quarter. And if we start to see, a more aggressive, more accommodated Federal Reserve, and it won't be because they think the economy is contracting. They might want to run the economy hot. They might want to run the economy with a little bit higher inflation, with a little bit lower yields, So it's easier to service the debt, to really kind of, maybe bring some of the budgetary concerns into play. I don't know, that's way above my pay grade, but I would think there's going to be a lot of equity markets leading, pricing in low yields with the bond market. And then as the bond market starts to get there, it's going to run through fits and starts, and that's going to put the bond market back in control. So, but I think for the most part, unless again, something untoward happens next year in terms of inflation or supply demand or economic contraction, there is a sweet spot. Good girlfriend, bad girlfriend.
Oh man,
bad girlfriend. Now here's the thing: her boring friend shows up. You broke up. Now you have a new boring girlfriend. She doesn't want to go out at all. Now, that's when the 10-year gets below like 2.25. Now she's
in my experience, good boring girlfriend probably is safer at this stage in life for me than bad girlfriend anyway. So that actually kind of sounds, but I digress. I don't think that has anything at all to do with anything that we're talking about here. But don't underestimate.
I disagree.
Always.
I disagree. So the hot mess girlfriend, remember, she shows up at about 4.75. Okay.
Yeah.
The librarian snoozer, she shows up at about 2.25, right?
Yeah. So
we got to be careful. We got to make sure that we have to be happy with the relationship that we're in. What's that? How's that song go? Love the one you're with.
Yeah.
If you can't be with the one you love the one you're with. Well, we love the one we're with. I love the one I'm with. I love this. We're right here, 4% on the 10-year, 3.5 would be a little bit better.
Yeah.
That'd be great.
Just don't ever
love
shoot
the one you're with. And so the equity markets, that's going to be the song for next year. Honey, love the one you're with.
Love the one you're with.
If it gets too far one way or too far the other, you ain't gonna like it.
Yeah.
You'll be bored or stressed out.
Yeah. Yeah. Neither's fun. Well, we'll see how it plays out, man. I appreciate. Thanks for the flexibility. Glad we're able to squeeze it in on a rare Thursday show today. But I hope you have a fantastic holiday Christmas party tomorrow with your team there. For anyone who would like to reach out to Matt and his team, don't call them tomorrow. They will be preoccupied tomorrow, but you can call them on Monday at 702-655-8300 or visit intelligentinvestment.com at any time and learn more. And they would be happy to chat with you. Matt, always a pleasure, bud. I will see you next week. I think we're on next Friday as normal. Should be.
Yes, sir.
Sounds good. I will see you then. For everybody else, stick around. I've got to play some disclosures, and we'll see you next time.
Have a good weekend.
You too. See you, bud.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risk, and there is no guarantee of any future results, performance, or success.